All right, so we had an interesting turnaround. It was a little bit of a roller coaster ride, like that first hill on the roller coaster where you go up and then you come back down really, really high, and then that gets you that momentum that really picks up the pace on the downside, and then that really gets you going. So that's the idea here is we went up today, we went down quite a bit, a little bit of a, the Russell finished up, the S&P finished lower. But now there might be some like movement to really kind of get going from here. Obviously, we have earnings. We have Apple's earnings coming out. We have jobs report. So we have a lot of reasons. So there's the CPI is going to be coming out soon. Nvidia's earnings is going to eventually be coming out later. So there's going to be a lot of things that can still kind of move us. But it looks like today kind of we got up to the hill, we got over the hill, came back down, and now the question is whether we're going to keep going lower, which I don't think the case is, or now whether we'll get going back up to the upside. And I think that that's the more likely scenario. I'm going to break down why. Again, I don't think we're going to have a big move to the upside, but I think we'll get a short little intermediate run going into the rest of the second quarter. Into the beginning, at least the beginning of the third quarter. Small gains. It's not expecting a 27% run without a 2% decline again. But I'll kind of show you why and kind of what's driving the price action today. Kind of show some red flags that would suggest that we might be actually headed towards more of a decline. I think that's a lower likelihood, but we do have to recognize the red flags are out there that could derail this roller coaster ride back up to the next hill. So we'll talk about those. We're aware of those. We'll take a look, obviously, what's driving the price action from an intermarket relationship standpoint. We'll break that down. And then one of the really weak sectors today, which again is typically is weaker whenever the markets have been more bullish. We'll break down a trade idea on a stock that's breaking down pretty hard in that sector too. Kind of follow up on another trade we did in that sector. We'll do another one with this stock with the breakdowns that we're seeing. So let's go ahead and get started. Today is Wednesday, May the 1st, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I review all the existing trades we've done in old videos, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed in that class there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while we're watching. We can try to hit our goal of 100 likes on the Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're back to dark pink shading and a red line now for the second day here. Intermediate line, which means the intermediate line is still going lower. It's inside bearish territory. Your long-term market sentiment line is continuing lower too. Your near-term line fell back below the intermediate line. So yesterday, you can see we were at 47 on the near-term line and 38 on the intermediate line. Well, today you cross back below it. Again, when the intermediate line is between the reversal zones, any crossover of the blue line through the green line is either bullish or bearish. In this case, obviously bearish. Same thing with the market sentiment line. When it's between the reversal zones, then any crossover of the intermediate line through that line is a good, and really, if you cross over in any spot, but especially in the reversal zone, in between the reversal zones, it's either bullish or bearish, depending upon which way it's crossing through. So obviously not doing that yet. We are moving back lower. Both those short-term sentiment lines finished below the 5th percentile. Those are extreme lows for that. It's not very common for that to be the case. You can see we had a little bit of one right there. But again, that was mostly because of smaller ranges. We have not had smaller ranges the past 2 days, a little bit above average. And over here, we also had that where they both were below the 5th percentile and we rebounded. So you would expect we'll probably rebound here to the upside, and the question is going to be like how much. Will the near-term line be able to rebound all the way back to a bullish near-term peak, or will like this here, or will we end up getting, or even this one over here, or will we end up getting a bearish peak on the rebound, right? That remains to be seen. Your NASDAQ 100 looks almost exactly like the S&P 500. Intermediate lines rolling over. Back it's slightly into bearish territory. Market sentiment's falling in bullish territory. And you have extreme lows, slightly higher than the momentum line, but pretty much extreme lows there. So pretty bearish pattern. Again, dark pink shading and a red line. Almost exactly like the S&P. Your Dow is below the 23% retracement of this intermediate rally, so we're still in that retracement mode. Remember, you start the retracement when you get below it, you end it when you get back above it, so we're restarting this retracement. So we had light green shading there for a while. But in fact, not only are we back to dark pink shading, but your intermediate line is almost back into the reversal zone. In fact, this is how close, I mean, at 20.84, that's how close you were to getting another oversold cluster. If you finish below 20, like the momentum line, then you have an oversold cluster there with all three lines below the 20th percentile. We didn't get that, but we came really darn close. Again, it goes to show just how bearish the Dow is relative. Again, 2% below the moving average down there. Market sentiment lines falling, still in the upper half of the chart, but not in bullish territory anymore. So a lot more bearish from a long-term perspective than the S&P and the NASDAQ 100. And then finally looking at the Russell 2000, which was actually slightly higher today, up 1/3%. At one point in time, it was up over 2% on the day. And you can see its intermediate lines rolling over to a little bit more stronger into the bearish territory than the S&P, but not quite as low as the Dow. Remember, the Dow was on the cusp of that cluster there. The short-term sentiment is not as extremely oversold because of the fact that the Russell is actually up today. It did finish near the lows, but not at the lows, and just like I said, slightly higher. We are 2.5% below the 30-day moving average. So you can see the bearish posture persists. Dark pink shading and a red line, that persists. I told you that we typically don't get light green shading for very long. We either turn back to dark pink shading after a couple of days, or we turn into dark green shading. So in this particular case, we turn into dark green shading. But it generally only takes a day or two, maybe three, for that light green shading to persist. So we get the three green arrows, or the bear tag, sorry. We either get that bear tag, or we roll back over. In this case, obviously, we're rolling back over here. Let's take a look at the weekly chart. Remember, the weekly chart, despite the weakness this week, is still showing a transition candle, just like we saw last week. Again, the red arrow is still there. It is a bearish candle. You can see the size of the candle still negative. So we're not back up above zero yet on that. It's a weekly chart, so the crosses above and below zero are pretty significant in terms of when we begin and end these intermediate rallies. So we're still below zero on the size of the candle with that transition there. Looking at the three green arrow chart, well, let's go back really quick to the weekly chart because I wanted to show the difference with your Dow Jones Industrial Average. So your Dow Jones has still got a bearish candle as well. Has had a couple of kind of transitions here. Has been below the 10-week for now, multiple weeks in a row without popping back up. So PPO is falling. So you can kind of see more of a bearish pattern. But you also see we're not getting lower lows. We're not getting lower closes. So we're still in kind of this transition mode where either we bounce back up or we make a new leg lower to the downside, which appears to be that's the more likely scenario here. The more transitions that we get, kind of like this, the more transitions you get, the harder it is to reverse, right? You end up continuing the trend that you're in. Looking at the three green arrows, you can see again we don't have three red arrows. In fact, your Russell actually got a green arrow on the stochastic indicator, and you still don't have the red arrow on the MACD on any of the other three. So they have red arrows in their stochastics and the moving averages, but not. So that's what 4 days here. We've had 4 days of not 5 days actually of not having three red arrows on the S&P 500. It's been 5 days since we got that green arrow on the NASDAQ 100. It's actually been 6 days here without 3 reds. And then, of course, so I mean, this is a pretty good chunk of time that we haven't had 3 reds. So again, that's when you don't get the no shading at all. Remember, when you're bearish, you don't have periods of time that are very extended with no shading. You either turn right back up to 3 greens and you get the green shading, or you turn back down and we turn bearish again, which that's kind of what we're doing. And again, we're probably another bearish day away from getting back to 3 reds. So I think ideal scenario is we bounce back up tomorrow to try to avoid that. Oops, sorry, wrong chart. Let's go to this chart here. Again, we do have, we are back below the 8 and 17-day moving averages. They're both moving lower. In fact, your 30-day moving average up here is about to cross below the 50. Your MACD is still bearish. If it hasn't crossed back below the moving average yet, that's when you get the red arrow. Your stochastics also has not crossed back below its moving average, nor back into bearish territory yet. So, you know, again, we're not that bad, right? As bad as the last 2 days have been, yesterday and then the intraday move today to the downside, it's still not necessarily breaking down. We're definitely not below, here, if I were to take a look at it this way, we're definitely not below the lows of these clusters yet. We had closed up above the highs of the cluster, right? So there's the high of the cluster. We had closed above that for a few days until yesterday. We closed back below those highs, but we haven't closed back below the lows, right? That's kind of the significant reversal sign. Same thing with the Dow. We're not up above the high of this cluster, which would be right here. So there's your high of that cluster day that we had kind of a couple of days there that we closed above that. But we're also not below these lows yet either. So we're still kind of we're down. We're not bouncing, but we're also not breaking back lower yet to a new leg lower to the downside. Your DMI is still showing a bearish pattern. You're above 30 on the negative indicator, below 20 on the positive indicator. Looking at the RSI and the CCI, again, we are not back in the bearish territory. So still very neutral on both of these indicators here. Those colors still hasn't changed. I think I need to throw this on to today. Because remember, that doesn't turn red. It just turns off the green when the weekly CCI crosses below minus 100, which obviously it hasn't yet. So we're still okay there. And this one turns green from red when it gets back above 60. So it hasn't done that yet either. If we take a look at the Ichimoku cloud, we are in the cloud. So again, that's not bad. It's kind of neutral. Now, granted, when you're in the cloud, you tend to break below the cloud. So that's still a strong possibility that the longer we go without getting back up above this cloud here, the more likely we are going to be below it. And when we're below it, when the pink shading gets here, when we get to the pink shading and we're below it, the pink shading, then that's when you're more bearish. Like your pullback, your typical pullback should be back above the pink shading, so you get the pink shading on the pullbacks. But it's plotted 26 days ahead forward in time. So by the time you get to the pink shading, we should be done with the pullback. We should be back up above the pink shading and be fine. If you're still below it, it leads to a likelihood of a correction. Remember, this was right on the cusp of being, it was a correction on the Russell 2000, it was right on the cusp of being one on the S&P 500. So the longer we languish inside the cloud, the more likely we are to be below the pink shading by the time we actually get to it, especially with that negative rate of change and back to, or really close to, a intermediate trend strength. You got to get below -2 and above 65 together for that intermediate trend strength there. So we're right about there. Finally, in the Bollinger Bands, we're still not in the lowest quartile. So you can see how we're kind of neutral. Now we're on the low end of neutral, but we're not in bearish territory in any of these indicators. So as bad as the last 2 days have seemed, at least we're not in bearish levels on any of these things. You can see we're still losing negative momentum. It's still yellow, right? It turns red when it turns back down, the histogram there. Your bands are still outside the Keltner channels, and they kind of look like they're flirting with getting inside of them. So we'll see, if we get another rally or two in the next couple of days, your Bollinger Bands probably will move inside the Keltner channels, and you'll be back to red dots, which would lead us to a potential transition up to bullish momentum there. So again, it all depends upon if and when we close back above those cluster highs or below those cluster lows. And right now, obviously the fact that we can, there's a strong likelihood we close below those lows because we came back down. We failed to get above the highs. So it opens up the probabilities that we can actually get below those lows there. If you take a look at today's volume and trading range, it was the second straight day of pretty decent ranges above average, 8.32. Yesterday was 7.58, so we actually had a bigger range today. And you can see a second straight day of above average volume. So remember I told you before that volumes and trading ranges should be bigger below the moving averages, and that's what we're seeing here. Both to the downside and then to the upside. So we should get some strong moves to the upside if and when we make the run through that moving average there. Then once we get above the moving average, we should start to roll over on this. But you notice the volume's not very heavy, so it's not like we're peaking here at a very high level of volume. It's actually a pretty low level of volume, considering that we're on this intermediate decline, and it's a very low level of volatility too, considering we're on an intermediate decline now. We got up close to the 100%, similar to the last intermediate decline. Obviously, like the last couple of years, we haven't been able to get above the 100%, which back before the last couple of years, your typical intermediate decline usually got the VIX right around to the 105% mark relative to the VIX 3M, the 3-month VIX. So we haven't come close to getting above 100 on a closing basis in the last, how many years now has it been? Because we didn't do it at all last year during that pullback there. We didn't do it over here either. At the beginning during the banking crisis, we didn't even get above 100%. So the last time we finished above 100% on a closing basis was at the very lowest, like the wash out phase of that correction in October 2022, and we barely got above 100. And again, usually, because that was a correction, usually the corrections get up to 115%. So, this has been a very, very low, and I know a lot of people say, well, the VIX is broken, and that's why. Well, it's not just the VIX, right? The ATR, the volatility has been really low as well. We didn't even get, during the correction phase, we got above the 2, but during this intermediate decline, we didn't even come close to hitting 2 on there, or even to 1.5, which is right. I think we ended up peaking right around 1.33. So usually we get at least a 1.5 on your intermediate declines. Remember, that wasn't just a typical intermediate decline. It was bordering on corrections, and we still couldn't get even the ATR up to a very high level. So again, not just the volatility broken because of the 0-day expiration options. It's just a general lack of volatility in general, using multiple measures, including the Bollinger Bandwidth. Remember, the Bollinger Bandwidth would be another measure of volatility. And if you look at the last couple of years, for your typical intermediate rally, like here, let me go back so we can see the 2018, right? So there's your 2018. There's where volatility got during a pullback, right? During this correction here, and you can see that's where we got over here. But during this pullback, we didn't even like this rally up here occurred on the rally, not on the drop. So on this entire intermediate decline that was bordering on correction, we never did break the Bollinger Bandwidth up through the 150-day high of the bandwidth. So kind of, again, like that's you typically do during pullbacks or recession or corrections. And here again, we did break through it, but it was on a rally, not on a decline there. So it goes to show, like, it's not just the VIX. Even in the VIX, their VVIX is still near extreme lows. Remember, the extreme level is 80, so it's kind of near extremes. The VIX did not fall down nearly as much as the VVIX did. So it makes you wonder, all these other times the VVIX dropped, the VIX came down pretty low too. This one's just setting itself up for a much higher low point. If that VVIX were to bounce, which you expect it will, the VIX is already, they're flirting with that 200-day moving average. So you'd be coming off of a much higher low point above the 200-day rather than below all the moving averages. That would set us up for a potential break up above 20, which we did get last summer. We did not get so far on this particular intermediate decline. All right, now let's take a look at what's driving this price action. We'll take a look at the, obviously we know what happened today, the interest rate decision and the whipsaw around that decision, both to the upside and then back down to the downside. So there's your upward move here today. Everything, gold, real estate, everything. IWM was up over 2% on the day at one point in time at the peak. Qs were up. Emerging market stocks, developed market stocks, long-term bonds were up pretty sharply here, which means again that yields were down. The commodities were down, although they did rally during the initial response to the FOMC statement. The dollar dropped during the initial response, and then everything turned around. The dollar rallied, bond yields rallied, commodities fell, which is not typical. But look at everything. I mean, look how much the Qs fell down to 0.75% of a loss from being up over 1%. IWM went to a 2% gain, down to barely hanging on to a gain. Gold stayed higher, relatively speaking. Bonds, gold and bonds ended up being the highest performing asset classes of the day. IWM and then real estate following suit. So, pretty interesting back and forth move there of what's going on. Of course, you take a look at the dollar index, and you can see the big drop that it had here today. One of the big reasons for the dollar gains lately has been the yen, where the dollar yen has been up and down here. Well, you can see this is since this period opened, which is just barely with the last few hours. The dollar yen is already up that much after dropping today, because that's, if you look at all the currencies and how they moved here, let's pull up the currency comparison chart and just look at today, May 1st. So here we go. So the dollar was down, the yen really took off. Look at that big jump. That was a lot of people talking about intervention, the Japanese coming in and intervening in their market and pushing the yen higher against the US dollar. The pounds down here, the francs down here, the yen pretty much rallied against everybody. At one point in time, it was the Swedish krona, the Mexican peso, the South African rand, all kind of commodity-based currencies. Norwegian krona, Australian dollar, New Zealand dollar, all commodity-based currencies. Still all finished today mostly higher, despite the weakness in commodities themselves. And then your European currencies, the franc, the pound, the euro, all declining against all these, but gaining against the dollar, right? So the dollar was down across the board against just about everybody. But if you look at, again, just today, like here, let's go back to the currency comparison chart and look at how things are going so far, right? Because the currency market is a 24-hour market. So if we go to May 2nd, I don't think it will let us here. Yeah, it's not going to let us here on this particular chart. But you can see, again, you saw the dollar's already rebounding against the yen today. Again, in just a few hours here. Let's look at it on this chart and see if it will pop up. Okay, so there we go. So there's the rebound off of that low point here. So it looks like it starts at 250 right around my time. There's the rebound there. Nice, good rebound up to the upside. If you take a look at the euro, the dollar against the euro, the euro is also falling against the dollar too. So the dollar is already, and now it's not rebounded nearly as much, right? There's the post FOMC move. The euro took off against the dollar. So we still got a long ways to go. But, we are not pushing through to new highs either, and we're already pulling back. So keep that in mind about your dollar move, that it's not really, we're probably going to be back above the 8-day moving average by the time we get to the stock market open tomorrow morning, if these overnight moves hold. Of course, the other big factor in risk appetite lately has been bonds. Bonds and stocks, remember, right now are pretty strongly correlated with each other. If you look at bonds relative to stocks down here. You can see for the most part they're pretty strongly correlated. There's been brief periods where they've been kind of weakly negatively correlated with each other, but there's brief, and you expect that they'll turn back up, which means if bonds are going to turn back up to the upside here, which means yields will fall, at least towards resistance, you would expect that would rally stocks up too, considering their typical positive correlation during an inflationary environment. Otherwise, if bonds continue to drop, which I wouldn't expect that they would, right now they've been on a near-term decline. You can see we've pulled back on the near-term line down. The intermediate line still very oversold. So you would expect that we'll break, at least bounce up towards the moving average, and then we'll see if we get a bear tag that fails, like the last so many bear tags have. There's been one that hasn't failed. All the rest of these in the past year have. So do we get a bear tag that will fail or not? Because you can really go bonds can go quite a bit to the upside before past the 30, just up to the 200, but then it'll be hard for it to pass that, right? It's already failed multiple times at the 200-day. This time it's got that point of control right at it too. It's going to be very, very hard. Not that it can't. It'll just be a very strong resistance level there that will keep it. And again, if bonds roll back down, again, with the positive correlation, you would expect that will be bearish for equities. Again, that's if. I mean, we're in a convergence mode right now. So we're kind of basing, and we'll see if it actually turns in. I expect that it will turn into a bullish move for both bonds and equities. And of course, the other factor is this drop in commodities, and that's a pretty decent drop. Now, there's not much more downside left to commodities. You got the 50-day moving average there. You got the point of control. So keep that in mind. It doesn't look like commodities will have a lot further to fall, and will end up most likely forming some kind of higher low point there. So of course the big factor here is crude oil flirting with its 200-day moving average. If it were to break further below that, now we've got something, right? So we'll see if this ends up being a fake out or an actual breakdown to the downside on crude oil. I expect that we'll actually bounce back up off of this, and we'll see if that ends up being the case or not. Let's take a look at the it was fascinating, the up and down. We ended up negative on the day. We were pretty positive at the highs of the day today in the McClellan oscillator. We're still negative again. We need to pass through that positive 35 level. Otherwise, we're just not getting very much breadth at all. If we take a look at the number of stocks above their 50-day moving average, we've been monitoring that very closely. We're back below 200 there, though we were a lot lower at the lows of the day today. The number of stocks above forming new highs and new lows is still net negative, but not below the moving average. So kind of a common theme here. We're not bullish, we're not taking off, but we're also not bearish anymore either on a lot of these patterns. So more likely that we will maintain some kind of bullishness. Again, probably not as strong as what we've seen, but some type of bullishness. We've been looking for that wide breadth thrust. We got one more day today, and it's very unlikely that we'll finish above 61.5 tomorrow. So we're not going to get that thrust, and we'd have to get back below 40 to open up the potential for a new one there. So it kind of goes with the theme that any bullishness we get probably won't be very strong. Your Qs drop versus IWM today. Again, that's typically been bullish, moving towards the 200-day. If we break the 200-day, now we're going to be a lot more. There's going to be a lot more bearishness there, in my opinion. As you can see, we're continuing to rotate towards safety. XLP is up here, XLV, XLU, all got the strongest momentums. They're all in the leading category along with financials. Real estate and discretionary are moving up too, so that's a positive development. They're more cyclical there. XLK and XLC are in your lagging categories, which are your other. These are probably two really, really important. Amazon and Tesla are really the only two XLY companies. All the other big names that we look at in this Mag 7, it's actually 12 stocks here that make up the biggest names in those three sectors. You can see Nvidia breaking back down, Apple breaking back down here going into its earnings, Broadcom breaking down pretty sharply, Cisco giving this oversold cluster still, Netflix still below Adobe still below. AMD rolling over and breaking back down. So Microsoft, lots of dark pink shadings and red lines here. Got some light pink shading that's almost dark pink on Broadcom, and you're likely to turn dark pink and red line on Nvidia too if we get another down day. So you can kind of get the idea that, you know, a lot of these big tech names, again, Amazon and Tesla are the only ones that are in XLY. Everything else is in XLK and XLC. You can see why these two have been able to hold up discretionary. Everything else has been kind of showing, and that's, you know, again, we continue to see the weakness in XLK relative to the broader market, really breaking down below the 50-day. Looking at it here on this chart, XLK relative to SPY, again breaking below that 200-day moving average as well. Very significant breakdown on that. PPO is falling sharply there, so you know, things have changed pretty dramatically for risk appetite when XLK, which has Apple, Microsoft, and Nvidia, the three biggest companies in the U.S., underperforming, and then XLU is breaking above today its 200-day moving average, the ratio, the 200-day moving average of the ratio line to SPY. So you get the idea here that, and there's your long-term moving average turning up, the positive momentum, bullish indicators on all these different oscillators here. So again, that's not a typical sign of risk appetite, and it's more a sign of risk aversion than anything. Let's take a look at this sector comparison chart for today. It was an interesting pattern today here. If you take a look at, you know, again, at the height of the session, utilities were your second best performer. They held up the best by the end. XLC held up pretty well too by the end, ended up with almost a % gain. Everything else down, XLK especially, XLY dropping down to where XLP was. Consumer stocks really getting hit hard, and energy was a big loser on the day as well. And that brings us to our trade idea of the day. I want to take a look at Halliburton in that energy sector. Halliburton has really turned around, have been pretty decently bullish, got a lot of bull tags, wasn't bouncing but wasn't breaking until yesterday. And then it followed through today with some pretty extreme bearish short-term sentiment, down 7% below the moving average. Market sentiment, we had already crossed below it. It's rolling over now. So things are changing for one of the bellwethers in that energy sector here. Looking at this long-term chart, give it a second here to load up. There we go. You can see we are closing below the 10-week moving average, and we're that close to closing below the 40-week exponential moving average, with a pretty sizable bearish candle there, one of your bigger bearish candles that we've seen here in a while. Obviously, you have 3 red arrows on Halliburton. You can see you had pretty decent volume the past couple of days. You broke below the 50 and the 200-day yesterday, and the point of control for that matter. But you were just kind of barely below the 50 especially. Well, today you're not just barely below. So it's a clear breakdown. Sentiment has definitely changed in the energy sector, in that energy space there. You look at the DMI. Now it can change back, right, for whatever reason. But as of right now, you can see it back above 25 on the negative, already below 10 on the positive. So that's a little bit of a red flag for any downside moves, which is why we're not going to be too aggressively bearish here. You're below 40 on the RSI. You're below 200 on the CCI. The CCI is breaking below 0 on the weekly chart. Looking at the Ichimoku cloud, you are breaking into the cloud and potentially going to go through it here. You don't even have the beginning stages of a weak trend yet, so we haven't even started trending on that. And then finally, looking at the Bollinger Bands and the Keltner channel, you are into the lowest quartile of the band width. And you're breaking below the lower Keltner channel. So with some increasingly bearish momentum, things have changed. So what I decided to do here, like I said, I don't want to be too aggressive to the downside, but I decided to do a bear call spread right about at the money. We were kind of right at 36.50 when we did the trade in the Market Outlook Live video. And you can see they're still pretty close in the extrinsic value. But we sold the 37, bought the 39 to keep for risk management sake. So we're getting a pretty decent return here and our break even is basically has to reverse this move that we've had below these moving averages, right? So we'd have to get back up above, into the value area, and then back above today's high point essentially, and for that matter back into last week's above last week's low as well, and we'd also have to get above, when you look at these moving averages, you'd have to get back up above that 50-day moving average and pretty much that 200-day moving average as well, which now, since we broke down so far, you've got, those are some pretty strong resistance levels with the point of control as well, that are going to kind of hold us down, hopefully below this area here. And then we can get a pretty decent return. Ideally, because we're so far out, 51 days, if I can get at least a 50% or more return in the next 31 days, then I can employ this $1,000 to work somewhere else and try to get a maximum gain in the last 20 days of the cycle. So instead of just waiting for the other half of this maximum gain, I can go get a full maximum gain somewhere else. So I'm hoping as the stock drops and extrinsic value really comes out of the calls way more than it does puts, that I can get to a pretty decent return pretty quickly, which happens a lot. If you're right on the direction, it happens quite a bit on these short vertical spreads, on the bearish short vertical spreads. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow me and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.